What is up, everyone? Welcome back to Investing Club. In this video, we're going to be talking about FAANG stocks, the super popular tech stocks that everyone loves, and I'm going to be talking about my view on these stocks and if I think they are trading at a fair valuation, if they're overvalued, or even if some of them are undervalued. And to do this, we're going to use a very unique valuation tool. So stay tuned in this video so you can see that. I guarantee you haven't seen this method of valuation before. So for anyone that doesn't know, the FAANG stocks stand for Facebook, Apple, Amazon, Netflix, and Google. And these five stocks have dominated the past decade. And right now, all of those stocks make up something like a quarter of the entire S&P 500 because their market caps have swelled up so much. So I'm going to go right down the list and we will start with Facebook. So here we go with Facebook. I'm just going to point out a couple of things first. Their market cap is almost $700 billion. So Facebook has become a very large company compared to when they first became public less than 10 years ago. The other thing I like about Facebook is they have absolutely no debt. Their long-term and short-term debt is non-existent, and I think that is a very good quality for a company in these times, like I've said in previous videos. The third thing is that profit margins are 28%. This is part of the appeal why so many people like tech companies, because they're very asset-light businesses, so a large part of their revenue makes it through the income statement and comes out as profits because they don't have as many fixed costs as companies in a lot of different industries. So now let's get to looking at Facebook stock through a different lens of valuation. And what we're going to be doing is using a reverse DCF calculator. So you may have heard of a normal discounted cash flow calculator, which is something that I use a lot. And what you do with a discount cash flow calculator is you say, all right, based on how much money this company is expected to make in the next 10 years, we can discount that back to right now and we can see what the stock should be worth right now. And then we can see if it's overvalued or undervalued based on that. The reverse discounted cash flow formula turns this on its head. And instead of using the future growth to find a price today that a company's worth, we're actually going to use the price of the stock it's trading at today, and based on that price, what kind of growth do we need from this company to justify the price it's trading at today. And I think this is a super important way of looking at stocks. So let's see an example with Facebook. The website I'm on right now is gurufocus.com, and you can do this for free. I don't have an account with this website, but here's the bottom line with Facebook. Based on where they are right now, their expected earnings per share growth rate has to be 22%. And this website will tell you what the company's growth has been. So over the past 5 years, Facebook's growth has been over 50%. So this was an insanely fast growing company, but in the last year, they've only grown at 8%. So the question is, over the next 10 years, can Facebook grow at 22%? If you think they can, then this would be a good buy. And Facebook, I think, is probably the most undervalued FAANG stock out of the group because 22% isn't impossible to achieve for them. I think Facebook has a pretty good chance at growing at 20% over the next 5 to 10 years. Just for some context, going back to Facebook, the estimates over the next 5 years are Facebook grows at around 16%. So even though I think Facebook is the most realistically priced out of all of the FAANG stocks, the price still seems a little high right now at over $240. Now, if we saw that price fall a bit to around $220 or lower, it's at that point where I think Facebook starts to get fairly valued. And there's where I would feel comfortable buying and holding Facebook for the long term. So the next stock is Apple. Apple's been on an absolute tear since March, and they're at a new all-time high right now, just under $400 per share. Now, Apple is an absolutely massive company. Their market cap is $1.6 trillion. So this is a company that's worth over $1 trillion, and their growth over the next 5 years is still expected to be 11%. So for a company that's so big like Apple to be still growing at double-digit rates is a pretty amazing thing. Apple's profit margins are also 21%, so a great sign to see. But now let's see if their valuation makes sense for their expected growth in the future. So based on the price of Apple now, the expected earnings per share growth rate is around 21%. And that means Apple would be a good buy at today's prices if you think their company can grow at over 21% a year. Over the past 10 years, Apple's been growing very fast at 21% a year. But what we see from Apple is as they've matured as a company, their growth has slowed down. Over the past 5 years, it's only been 12%. And in the last year, the growth is only 7%. So in my opinion, can Apple grow at 21% a year? My answer is probably not, because they're already such a massive company. For a company that's over $1.5 trillion to be still growing at over 20% a year just seems pretty unrealistic to me. You know, back 10 years ago, they were a much smaller company, so I think it was a lot easier to grow at these fast rates back then than it is right now. And like I just showed you from FinViz, Apple's only expected to grow at 11% a year over the next 5 years or so. So Apple's only expected to grow half as fast as the price right now suggests that it should be. So because of that, I don't think Apple's fairly valued. I think they're quite overvalued. And for that reason, I would have to wait for Apple to fall quite a fair bit before I would consider them to be undervalued. Now we're on the third FAANG stock, which is Amazon. And Amazon is another stock that's been on a roll since March. And Amazon is also a $1.4 trillion company. So Apple and Amazon are both trillion-dollar companies. And I think the most amazing thing about Amazon is their growth over the past 5 years. Their earnings per share have grown at 115% per year. So what that means is every year over the last 5 years, their earnings have doubled. And that is just something insane to think about with how big Amazon has become. So with that, let's see what investors are expecting to see Amazon grow at based on their current valuation. Now, for expected earnings per share, Amazon would have to grow at 45%. But like I've said in previous videos, if you watch my other videos where I talk about Amazon, I said that most investors only care about Amazon's cash flow, not their earnings, because they're reinvesting so much of their profits back into the business that Amazon will never look like a very profitable company. And the good thing about this calculator is that it lets us use either earnings or cash flow. So we can switch that over here. We can switch it to Amazon's free cash flow. And right now, we can see that their growth rate dropped. So that makes sense. Since their cash flows are stronger than their earnings, their cash flows won't have to grow as fast based on their current price, but they would still have to grow at 35% a year. Now, can they do that? I think it is somewhat reasonable. Over the past 10 years, their free cash flow has grown at 28%. So they're right in that ballpark over the past 10 years of growth. And over the last 5 years, that is actually sped up and gone closer to 50%. And so I actually think this could be achievable for Amazon, especially if they stop reinvesting in their business so much. As they mature as a company, they're able to pull out more profits from the business instead of reinvesting and growing. At some point, Amazon's going to transition from this growth company to a mature company that's throwing off tons of cash flow. And I think we're going to start to see that in the next decade. So to me, it makes sense right now. Amazon looks like it's at a reasonable valuation. Now, I wouldn't buy Amazon right now because I like to buy stocks when they're undervalued and deeply discounted from what I think they're worth. And so if you bought and held Amazon right now, odds are you'd make a pretty good return, but I would wait until the price drops a little more with Amazon before I would buy into them. All right, so the fourth of the FAANG stocks is Netflix. Netflix has also done very well over the past decade, and here are some reasons why. Their earnings were growing at 44% a year. Their return on equity was 30%, so the management of Netflix knew how to reinvest back into the business to grow their profits. Now, from a traditional perspective, they do look overvalued. Their forward PE is a 60, which is very high. So now let's look at the reverse discounted cash flow calculator to see if it matches up with what a traditional valuation says about Netflix. So for Netflix to be fairly priced today, they would have to grow at 40% a year over the next 10 years. Now, personally, I don't see this happening. Over the past 5 years, that's what Netflix grew at, around 40 to 45%. Over the past 10 years, it was 28%. So in my opinion, Netflix's peak growth was in the past 5 years. Now, I think it's going to be very hard for them to continue to grow at such a fast pace when their market cap's already swelled up so much and you have so many more competitors coming into the space that Netflix is in, the streaming industry. You now have HBO, you have Disney Plus, Amazon Prime, and others entering into this industry that are going to be competing. So I definitely don't see them growing at 40% a year for the next 10 years. So for that reason, I'd say Netflix is quite overvalued, probably the most overvalued out of all the FAANG stocks, in my opinion. Netflix is a company I would buy, but I'd have to see the price fall a lot for me to consider buying in them. So the last company of the FAANG stocks is Google. Google, another company that's done insanely well over the past decade. They are also a $1 trillion company. They just passed a $1 trillion market cap. And another good thing about this company is, like Facebook, they have practically no debt. Their profit margins are also over 20%. So this is another asset-like company that can produce profits without many fixed costs. So for Google, their expected earnings per share, based on the price they are right now, for them to be a good buy, their earnings would have to grow at 18% per year. And I think this is a fairly reasonable rate for Google. Over the past 10 years, it's been 13%, but over the past 5 years, it's been about where the target is, around 18.9%. So if you expect Google to keep growing like they have been over the past 5 years, then this would be a good price to buy Google. Now, in my opinion, this is just a little too high for the stock. I think it's not there yet. I think if we got a little lower with Google, it would be a lot more realistic. I think 18% is a big ask for Google. They're already such a mature company. They have a $1 trillion market cap. So I think their growth will be a little lower than 18%. But the thing to note about Google is they are making a lot of investments. They just invested a ton of money into India, which, when you talk about technology, India is the land of untapped potential for technology companies because half of India's population isn't even on the internet yet. So if Google can capture a part of that growth as more of the population begins to come online, that could be a major factor of growth for Google. Google also has a ton of subsidiaries like YouTube and Waymo, the autonomous driving company, where most investors aren't even valuing Waymo into the price of Google stock because Waymo isn't profitable. They're looking at the money that Google's making. But if Waymo becomes a big thing in the future and autonomous driving becomes as big as everyone expects it to be, again, Waymo could be a huge source of growth for Google. So for Google, I think at first glance, they do look a little overvalued, but if you look at the assets they actually have, again, subsidiaries like YouTube and Waymo, the future looks pretty exciting for Google. And I do think they'll continue to keep growing, though maybe not as fast as people are expecting based on today's prices. So that is what I think about the 5 FAANG stocks. If I had to buy one right now based on their prices, I would probably buy Facebook. I think they are the most reasonably priced. And for which one I would stay away from right now would be Netflix. I think they are way overvalued and their industry is becoming very competitive as a lot of major players are entering the streaming space. So let me know what you think about these stocks. Let me know if you agree with me in my analysis. Let me know what you think about this reverse discounted cash flow calculator if you think you're going to use it. And that's it. So I'll see you on the next video.